All right, welcome again to ACG Silicon Valley's M&A Circle event on what to do when SPAC calls. I'm Yvonne Schwab, ACG Silicon Valley CEO. For those of you new to ACG Silicon Valley, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACGSV is offering a variety of virtual events in the coming months. Next week, we have our CTO Innovation Circle on California consumer privacy and an event on supply chain upheaval. The week after, we are collaborating with our ACG Detroit chapter on the future of automotive powertrains, followed by part 3 in our joint web series with ACG Austin San Antonio and ACG San Francisco. This time, we will be evaluating rising tech stars. Many more events to follow in May and June, so we invite you to visit our new and improved ACG website, acgsv.org, to see the full calendar. Now, I would again like to thank our sponsor, RSM, for putting together today's event and being such a great supporter of ACG Silicon Valley. Without further ado, I will now hand over to Lynn and Amy to introduce themselves and get us started.
Hi, everybody. My name is Amy Kasdan. I am a tax principal at RSM. And for those of you that are not aware of RSM, we are the 5th largest accounting, tax, audit, and consulting firm in the US. We focus on middle market clients, and we're #1 in the middle market. A lot of people know us for our audit and tax capabilities and may not be aware of all that we can do on the consulting side. And it's why this is the perfect event for us to be speaking at, because I've joined with Lynn, who is a director in our consulting practice. Her specialty is technical accounting. And we are here to discuss SPACs with you, what to do when a SPAC calls, specifically as it relates to the technical accounting and other piece of it that's not just an M&A transaction, as well as also to talk about the tax considerations that you might not be thinking about, or so that you have an idea in your head, these are the quick hitting things that I need to be concerned with. And I apologize, I did Lynn's introduction for her, but Lynn is with us, so thank you, Lynn. And I don't know if there's anything else you want to add, or I can just keep on going since I took your fire.
The only thing I would add is that I am focused in our capital market readiness practice and work closely with targets of SPAC transactions as well as the SPACs to help navigate getting from a private company to the closing of the transaction. And then we continue to assist the company with their first filings with the SEC, be it a Q or a K or an 8K, where they're helping all the way along.
Great, thank you, Lynn. So one of the things that, there's a lot of different things we can unpack when it comes to SPACs. Before we jump into the nuances we want to discuss today, we thought it would be a good idea to just level set with a baseline, some definitions, and who the players are in SPAC transactions. We only have a couple definitions to walk through, but I thought it would give a good level set for everybody. The SPAC itself, Special Purpose Acquisition Company, is an entity that's formed by a sponsor with the specific purpose of raising capital in the public market. They do this to make unidentified acquisitions of one or more operating businesses with the specific deadline of completion. And that's going to be key when Lynn starts to talk about the number of SPACs that have been happening lately, that specific deadline of completion. The SPAC is going to raise some funding, and those IPO proceeds are held in trust accounts that can be accessed only to the completion of such acquisition. There's usually a time frame, 21 months or less, that transaction has to be completed. You have with your SPAC generally a sponsor. The sponsor of the SPAC most commonly receives about 20% of the SPAC pre-business combination common stock, and this is their compensation for both fronting costs, finding and completing deals. And so it's somewhat thought of as economics similar to when PE might have a carried interest, but it's certainly not the same. But it is that 20% is what we're usually seeing the sponsors take. And I know that there have been a lot of webcasts and talk on the sponsor side of things and the SPAC side. And again, our focus today is really on the company side, the target, if you will, but wanted to walk through a couple of these beginning definitions. And if the SPAC completes the acquisition, the historic owners of the target company through the SPAC transaction become a public entity. We're seeing now more often than not, the target shareholders are retaining a majority of control. I know in the past, a lot of definitions and presentations, people said they may retain a majority of control, but what we're seeing most commonly is that they are maintaining majority of control. And then after the transaction is completed, we end up with our target company is now public. There is the one thing that I like to keep in mind when we talk about SPACs is I call it the marriage of two worlds. You have companies that are looking to do a transaction. I work in M&A tax. That's my sweet spot. I can talk transactions all day long. You also have companies that need to go from being private to public, and there is an entire IPO readiness timeline, if you will. And I use that term loosely because we're not doing an IPO, it's through a SPAC transaction. So Lynn is going to jump in now, and while we're covering some basic definitions before we get into some nitty gritty of considerations, and talk about some of the general life cycle and anything else that I missed in this brief overview of who the players are.
So the SPAC as a public entity will have its typical, your typical public company filing requirements that are the same for any other SEC registrant up until the time of the acquisition. The SPAC is responsible for those. They're going to do a filing of the Q and the K. And
by the grocery stores and put it in the house. And I'm gonna make.
Oh, I think someone might need to mute.
I just muted them.
Okay. Sorry. And so they're going to be responsible for all the filings up until the closing of the transaction with the target. And at that point in time, any filing from the closing date of the transaction forward is the responsibility of the target. And that's something that seems to be missed sometimes in these transactions, is that from the closing forward, that first 8K that is needed to be filed, any additional security registration statements that need to be filed are the responsibility of the company. So something to keep in mind as you are progressing through a transaction with a SPAC in the process is those are going to be requirements that you'll have to take ownership of post-closing. Up until that point, it's the SPAC's responsibility. And I think one of the items we wanted to make sure we highlighted at this point was the warrants issue. So the SEC issued a statement in the middle of April related to the accounting for the warrants. Oftentimes, the SPAC is issuing warrants to its sponsor and early investors. And historically, the SPACs are accounting for those with equity classification, and that determination might not be appropriate based off of the SEC's recent statement. And so this is, a finding that people are worried would cause a hiccup in the process of a SPAC, or might make the SPAC transactions go away, and that's not necessarily the case. It just is requiring all those SPACs to take a pause and look at how their historical accounting treatment was and whether it's appropriate, because if they determine that they need to change the classification to be liability classified, they have to go backwards and do a restatement. That doesn't mean the SPACs are going away. They just have to do some accounting cleanup, which is, we're seeing a little bit of a pause as the SPACs are determining what that appropriate treatment is. There's no transactional impact. There's no impact to the target. It's not something that would become a consideration of yours until after the closing of the transaction, when the warrants are your warrants, and at that time the accounting's already been determined. But so this graph that Amy has shown now shows the trend of the number of SPACs that have filed an IPO over the past 13 months or 13 quarters. And you can see a large jump from 2020 forward. And that a lot of that can be attributed to, the publicity of the DraftKings SPAC and how it made SPAC a everyday term for people in accounting at that point. SPACs have been around since the 90s. There's just a handful of them every year. And the volume of it has really picked up in the past 18 months. And so there's a lot of dollars out there where, to Amy's earlier point, that these SPACs, their whole purpose, they're formed to do an acquisition. They need to take the money raised in an IPO, and they can only spend it on an acquisition. That money sits in a trust until the acquisition closes. And if the SPAC cannot find a target, the money goes back to the investors at a little bit more, a few pennies more than what the investors bought in. So it's a pretty secure investment from the investor standpoint at IPO, because they get all that money back if the company can't close a SPAC. But there's a lot of dollars sitting out there right now that these SPACs are going to be looking to close target transactions in the next 18 to 24 months. And if they get to the end of the 24 months and they haven't closed the transaction, they're able to extend several times through board approval and can, I think, get it upwards of 3 years before they would have to dissolve and liquidate and send the money back to the investors.
So Lynn, this was, with all of this going on, I think one of the big things that you can help shed light on is, if a company's called by a SPAC, we're hearing a lot that companies are just being called up randomly that a SPAC wants to buy them. They weren't even thinking IPO. Some are, and certainly the SPAC can be a faster route. But, what are you most often having to educate your clients about when they come to you and say, we either want to do a SPAC or we were called up for do a SPAC transaction or we were called up by a SPAC? What does the education process look like for you to help them think through that?
Yeah, so this is a good slide for you guys to absorb kind of the process. You're looking at least a 4 to 6 month timeline from when you get the original call of a SPAC is interested to closing the transaction and operating as a public company. And so 6 months sounds like a long time, but most companies that are deciding to go IPO have been planning for 12 to 24 months before they start their process of preparing their initial registration statement. So in that comparison, it's a much more condensed time. And so we try to educate on what the steps are, because there's a lot of non-financial stuff that needs to be considered, as well as accounting, tax, and finance considerations. So a lot of the time, there's a lot of pressure coming in from the investment bankers related to how quickly can we have PCAOB audit opinion on our financial statements. So that's usually one of the biggest asks and the biggest differences, is that as a private company, you've been having AICPA audit opinions issued on your financial statements. And now you need to go backwards and have an PCAOB audit opinion issued, which means a re-audit of the past 2 to 3 years is required, depending on whether you are going to qualify as an emerging growth company. And so a lot of private companies will qualify as an emerging growth company, but we want to make sure that the target company is consulting with legal counsel to ensure that they do meet that criteria, because that drives how many periods are going to be presented in your SEC filings. But the first long pole potentially with needing to get a PCAOB audit opinion is, are your incumbent auditors, are your existing auditors independent under the SEC rules? And so something to think about here is, have your auditors prepared your financial statements? have your auditors prepared your tax provision? Those are two of the biggest, not the only ones, but two of the biggest areas where if your audit firm has prepared either your financials or your tax provision, they're not going to be considered independent under SEC rules in most cases. And so you want to start having that conversation with the audit firm to make sure that they are determining whether they are independent or not based off of the services they provided you in the past several years. And if they are determined not to be, then you have to go out and engage a new audit firm to come in and complete your audit. And that can take, you know, upwards of 12 to 16 weeks. It'll take about a month for them to clear acceptance. And then you have a new audit firm coming in, doing an audit under PCAOB standards for, you know, no history with the company. And you get a whole new level of scrutiny. And then in addition to having that audit firm come in and redo the audit, in the past, your audit firm and audit partner have likely been able to do a lot of documentation of your complex areas. So think business combinations, preferred stock agreements, convertible debt agreements. Those types of agreements have been documented in the work papers of the audit firm, and that doesn't fly with the SEC. Under a PCAOB audit, management has to prepare that documentation, which means in addition to going through the re-audit, anything that your incumbent audit firm or your new SEC independent firm is going to ask for, you're going to have to prepare. And that's a lot of the times where my team gets involved, is helping management document their positions to provide management position papers to audit firms. And then the purpose of that is if the SEC has any sort of inquiries around the positions being taken, you already have your documented position paper that backs up the whys behind the position you've taken. And it's not for auditor purposes, it's really to make sure that you're prepared for any level of SEC scrutiny that might come through the review of either your initial registration statement or your Ks or Qs, or any of the other filings that might come down the road. And so that's usually going to be the first focus of the investment bankers and the SPAC, is how soon can this PCAOB audit be completed? And they're going to have a lot of pressure on management and finance to get it done as soon as possible. And so the biggest educational piece I have is the slides you see in front of you of what's happening in each month. It is going to take about 4 months from the time you start talking to a SPAC to when you're going to be ready to file your initial statement, because the SPAC's going to need to do a lot of diligence before they're ready to execute a letter of intent with the company. And then once the letter of intent is executed, they're also going to be doing additional diligence on the company and tax and some other considerations to make sure they're comfortable entering into a merger agreement with the target company. And as the diligence wraps, then you're going to start preparing an investor pitch deck to go raise additional funds from another round of financing that will close in conjunction with the merger agreement. It's called the PIPE investment. And that investor deck it'll leverage the deck that you might have had going to get another round of preferred stock or to secure a SPAC. But it's going to have to be changed and reviewed with high levels of scrutiny by legal counsel, because this investor pitch deck is going to eventually be filed with the SEC, and your legal counsel and the SPAC's legal counsel is going to be very detailed in their review to ensure that any number and any figure can be backed up to prevent lawsuits down the road from any of the investors that might claim that there was something included in this investor pitch deck that wasn't factually accurate. And so that process, you know, it could take as little as 2 weeks, and I've seen it take upwards of 8 to 10 weeks. And so it really depends on counsel, the SPAC, and the level of accuracy and detail that we want to be presented to the PIPE investors. And then once that investor deck is prepared, we're going out and doing the actual pitches to the investors, so the roadshow, and that can take 2 to 3 weeks in itself to be able to present. You're going to present to probably upwards of 40 to 50 different investors, some institutional, some not, in order to secure your PIPE round. And the reason there's a PIPE round is a lot of the times the SPACs will have between 100 to 200 million, but you want to raise 500 million. So you go out to raise a PIPE to get that additional funding that you want. And the merger agreement is going to close at the same time as the PIPE round to secure you. And so once the PIPE has been closed is the timeline for when you're going to be ready to look to file your initial S1, or sorry, not your initial S4 or proxy statement. And so that's, you know, that's really when you need the PCAOB audited financial statements ready at that point in time, because those are included in the initial filing with the SEC. And that initial filing doesn't happen until after the merger agreement has been signed and executed. So you have, you know, anywhere from 12 to 16 weeks before you really need those financial statements to be included.
So Lynn, that was, you know, illuminating, especially I'm the tax person here, not 100% my area of expertise, thinking through all of the accounting side of it. But, you know, it shows the complexity where we start with a question of what is the biggest thing companies need to understand or be educated on. And you started by walking through getting a PCAOB audit and independence and management's responsibilities for making their own decisions and documentation. And as you're talking through the timeline that it takes to get the PCAOB audit done, you just also mentioned everything else that's going on that they need to be aware of at the same time. So you talked about negotiating with the SPAC, diligence they'd have to go through from the SPAC, working with their lawyers to make sure that they have a good merger agreement with the SPAC and an LOI, getting this pitch book together, going out to raise PIPE financing. And all of this is happening at the same time. They're working to get PCAOB re-audits done and everything else lined up, which, you know, that's an inordinate amount of things that I think is illuminating that it is happening in such a small amount of time, especially when the topic started with what do people most need to know when they need to get that audit and the timeline for that audit. So did I summarize that fairly well for, you know, all the intricate things you're explaining? Because to me, that sounds like a lot. So please let me know if I summarize that well, but also I'm sure there are other considerations above and beyond just that PCAOB audit and the timeline that companies also need to be taking into consideration.
That was a perfect summary. And there's a couple additional nuances with a SPAC transaction in addition to what you might have as a traditional IPO, because a SPAC transaction is effectively a merger. And so as part of the SPAC transaction, you're going to be looking to prepare a set of Article 11 pro formas that give effect to the investors on what the transaction would have looked like had it already closed. So that's the point of the Article 11 pro forma financials, is to give effect and allow the investor to see how the company balance sheet and income statement would have looked like had the transaction closed. And while not as complex for a SPAC transaction as it might be when two operating companies are merging, it still has its nuances and complexities. And so the structure of the merger agreement is going to drive the pro forma. And the type of transaction this is considered. And so under GAAP, there are two options. It could be considered a forward merger, and that would be your traditional business combination 805 accounting, where you do a fair value step up to the balance sheet of the operating company, so the target. Or the transaction could qualify as a reverse recapitalization, which is treated as an equity issuance. There's no fair value step up. The historical books of the target company are those of the combined company going forward. And so it's a pretty important determination that drives the complexity in the pro formas. And there's a lot of control you have as part of the target company in your negotiations with the SPAC to be able to achieve a desired result. And so a couple of those facts to think about as you're going through negotiating your letter of intent terms as well as the merger agreement are big picture control. It comes down to the control of the combined company after the transaction. So in the situation, three of the big factors we look at are how much equity are we giving up? Is the target company giving up as part of the transaction? If the closer we get to 50% or more, it means the SPAC is going to have more control of the combined company post-transaction. And that fact will lead you to get to the accounting acquirer is the SPAC, and that helps support a forward merger conclusion. Whereas the smaller bits of equity that we give up, so the farther away we get from 50% to be on the underside, supports that the target company is the accounting acquirer, and that gets us to a reverse recapitalization determination. And so a few of the other factors are, what does the management team look like post-transaction? Is the management team mostly comprised of existing management, or is the SPAC inserting a CEO, a COO, a CFO into the mix and having some influence? And the third factor to really keep top of mind as you're negotiating is how many board seats does each company, the SPAC and the target, get to a point as part of the transaction. The more influence the target has with the board and appointing board members, the more that supports the accounting acquirer determination that the target is the accounting acquirer, and therefore this would be a reverse recapitalization. So there's no black and white here. There's a lot of gray judgment, and there's several other considerations to make. Those are just three of the many to consider. And so one additional document that would need to be prepared is the management discussion and analysis. So not something you typically are doing with your private company financials, but another consideration. And so I think the other item to keep top of mind is that, I spend a lot of time talking about finance and accounting changes, but your whole organization's going to have to go through a transformation. You're going to have to become compliant with SOX. You're going to have to be having formalized HR policies. You're going to need to make some considerations around corporate governance. There's going to need to be education of employees of what it means to be an employee of a public company, as well as directors of the company, and how the director's responsibility changes from being a director of a private to a director of a public company. And just, making sure there's a good communication plan on the transaction to employees. You want to make sure the morale stays high. The whole culture shifts a little bit when you go from being a private company to a public company because of the compliance. And so making sure that you have communication with the employees so that they feel part of the transaction and, aren't leaving the company. That's another high consideration. And so I know I've covered a lot of the finance and briefly went over some of the non-finance considerations. But I think one of the things, Amy, that I would like to hear from you is what are some of these tax considerations that target companies need to be keeping top of mind as they think through whether a SPAC transaction is for them?
Sure. And, that's always an interesting one because, again, I know this is probably the third time I've said this, but while going through a SPAC transaction, there are so many work streams. And I've learned so much about what it takes to bring a company public. I know Lynn and I work very closely together. Working together, she's learned a lot about what goes on with M&A deal negotiation on the tax side, probably more than she ever wanted to learn. And one of the interesting things is that while everything is going on with all of the work streams Lynn mentioned, you're also negotiating transaction agreements and you're thinking about the right tax structure. While we always say tax shouldn't be the tail wagging the dog, you don't want to get tax wrong. The last thing you want is to tell your owners of the company that all of a sudden they're going to have a very large tax hit that they weren't expecting. So on that side of things, there are very easy ways to structure transactions to do it in a tax efficient manner. We just have to be thinking about it up front and addressing it appropriately. And that's where, with all the multiple streams, it's really helpful to be thinking about tax and getting somebody thinking tax while everything else is going on. One thing that people sometimes think of is, does this mean that all SPAC transactions are structured the same way? The answer is no. I mean, it would be, but there's very, very common structuring that we often see. I would say the first question is, what is your entity classification? Which is the question that whenever I talk to non-tax people, they're always like, doesn't matter to me. They don't think about that. I know, at least when I'm working with anybody doing financial diligence, and I was like, I need to know the entity classification before I can actually advise on this. If it is a flow through for tax purposes, we're generally doing a different type of transaction than if it's a C Corp for tax purposes. The other considerations are, what's the desired outcome and what liquidity are the investors looking to get? We mentioned at the beginning, a lot of SPAC transactions, we're seeing the investors keep the majority ownership, which went to Lynn's point about determining how the transaction is accounted for. Understanding up front what type of liquidity you're looking for can dictate the type of transaction we do. So that's why I mentioned that. And I'll unpack each of these things shortly. So the three things that I say are most important is, what type of entity are you? What is the liquidity you're looking for? And what's your desired outcome? Maintain control or full exit? Working in the M&A space, I'm very used to investors looking for full exit. When you're thinking about a company doing an M&A transaction, you're either thinking we're PE backed and we're going from PE to PE or PE to strategic. We're finding in the SPAC space, it isn't full exit for the most part. So that's why I mentioned desired outcome of the transaction. So those are the three things that I always think about on the tax side of things. So why does entity classification matter? Well, if you're a flow through, I'll actually start with C Corps. They can be a little simpler or not, because we want to avoid double taxation. If you're a C Corp, we're not going to be able to do, we want to avoid double taxation at all costs. Lynn was mentioning on the financial side of things, depending on what type of transaction is, depends on if you do purchase accounting. On the tax side of things, if you're a C Corp, you are unlikely to do any type of transaction that will give an inside step up in basis, because that would cause double layer of taxation. The target corporation would be taxed at corporate rates and the shareholders would be taxed, and nobody wants that. So usually C corporations are looking to do some type of tax-free reorganization or tax-free transaction. The most common is a tax-free reorg, and that's, for those of you that are into tax code, it's your Section 368 reorgs. I like to call it alphabet soup. You have your A, B, C, D, E, F, G reorgs and a couple others thrown in there. But those are the reorgs that we're seeing people structure around in these SPAC transactions. And the question is, which reorg fits your facts? depending on the amount of cash that might be coming out to the existing target shareholders, is going to dictate cash to stock consideration, might dictate the type of reorg you do. Does the entity need to retain its EIN and legal existence? This is one that I see tripping up a lot of transactions because the company doesn't want to have to go out and get approvals from their creditors, go out and redraft their contracts, re-register in states. They might want to retain your actual legal existence or your EIN. Other times it might not matter. So it sometimes isn't necessarily even the tax implications that are determining how we structure the transaction, but what are the other added hurdles that you're going to have to go through if you merge the target company into the SPAC versus having the SPAC buy the target company's stock. So, but the point being is the most common structure I'm seeing is 368 reorgs when you have a C corporation. And what this achieves is that the target shareholders exchange their stock for SPAC stock in a tax deferred manner. There's no tax paid at that time. And then after the transaction, they own SPAC stock going forward. The nitty gritty that gets into this is understanding which type of reorg we're going to do and can we accomplish this. There is one other type of structure that we're seeing with C Corps that is not as common because of the 20% that I mentioned that the SPAC sponsor owns. This is called a tax-free incorporation. For those of you that like code sections, it's your 351 transaction. And this would essentially be where target company is contributed into the SPAC and stock is taken back. There's some really specific rules on how much control target shareholders have to get after in the transaction. So when we couple this with the PIPE investment, maybe, and the target going into the SPAC, do they take back the requisite amount of control? We find it doesn't happen all that often, which is why we don't commonly see 351 incorporations as a way to facilitate a SPAC transaction. That's not to say it doesn't happen. It can be achieved. Sometimes you can do more complex structures where an entirely new company is set up. SPAC goes into it, C Corp goes into it, PIPE money comes into it, and we achieve the desired outcome. But then you have all the attorneys discussing what entity is the SEC registrant, what might need to be redrafted. We can get there, but it can add some complexities. It can also, the SPAC investors may have some issues with their warrants. So there's a lot of reasons why we don't often see the 351 incorporations, but it is something I wanted to make you aware of. So on the C corporate side, we're always looking for a tax-free reorg or a 351 transaction. In whatever we're doing, it's a tax-free transaction. Flow-throughs end up being a little more complicated. If you have a flow-through that wants to go through a SPAC transaction, there's two things you can do. You could decide now that you want to incorporate, become a corporation. So then at the time of the SPAC transaction, you can do a tax-free transaction and your investors will pay no tax unless they get cash back. That is something that we do see some partnerships doing, some flow-throughs doing. The other option is what is commonly coined in the industry is called an Up-C. It is where the partnership, because if we're talking a flow-through or a partnership, stays intact and the partners sell portions of their interest in the partnership to the public SPAC. That sale is taxable. The partners are going to pay tax on whatever they receive back. So if they receive a mix of stock and cash, you could have a disparate treatment where you have a taxable event because you received value in the stock and value in the cash received, but you only got a certain amount of cash. Other times you might only sell enough to take that you're getting the cash back and not everything, which is the most common transaction that we see. So in the future, you have the public SPAC that owns an interest in the partnership. The original partners still own an interest in the partnership, and they're also partners in the public SPAC. Why do we do this? Because then in the future, as the partners in the partnership want continued possibility to exit, they have negotiated an agreement with the SPAC that they can sell their partnership interest to the SPAC in exchange for public stock or cash. At that later date, the public stock may be exactly what you want. You either want to hold it or you're going to want to just then immediately sell it. But the idea is you sell some now for cash, you have a taxable event, you wait and sell the rest later on. Does this sound like a pain? If you're looking at me saying this sounds like a lot of work, it is, and it can be. The benefit though is when we do that initial sale of our partnership interest to the SPAC, there is a step up similar to your purchase accounting that you do for GAAP purposes. You get to do tax purchase accounting, if you will, and step up the basis inside that partnership, create a tax shield for the public company going forward. We are finding that the public companies don't really value that tax shield nearly as much as they're willing to pay 85 cents on the dollar for that tax shield created. So what this means is as you create this tax shield by doing a taxable sale of your partnership interest, you also negotiate for what we call a tax receivable agreement. As that tax shield is utilized, the individuals, the partners that sold their interest get paid 85 cents on the dollar of that tax shield. So it creates a payment stream going forward for the next 15 years to the extent those tax attributes are utilized. In case that went over everybody's head, because I know that either you're 100% with me or I lost you completely. I like to think of this as you are selling a portion of the partnership and getting inside intangible step up for tax purposes. That is going to shield the public company from paying tax in the future. As that tax shield is utilized, we determine 85 cents on that after-tax dollar savings gets paid back to the sellers. And that is the big benefit of these Up-C transactions and selling, going through a SPAC in this manner. I will say there have only been a handful of these previously, because as Lynn mentioned, we've seen SPACs, they're not new. They just weren't as popular as they are now. But we have seen Up-Cs happen. We've seen TRAs be negotiated. I'm finding that on every SPAC transaction I work on, people are thinking about these TRAs, and industry standard really does seem to be 85 cents on the dollar. The big question really is this company going to be profitable enough going forward that you're going to use the tax attributes created so that you sellers end up getting paid for them? That's the big $100 million question that we'll have to wait and see over the next couple of years as a lot of these SPACs play out and potential TRA payments are made. But right now, that's the thinking of why, if you're a flow through, you might want to stay a flow through and do what we call the Up-C. So those are some of the big kickers in the tax world for how the transactions are being structured. To take a big step back, we're first looking at, are you a C corporation or are you a partnership? If you're a C corporation, we're most likely doing some type of tax-free reorg, and the type of reorg is going to be dependent upon the mix of cash and stock consideration you're getting back, along with any other nuances in the legal world that you don't want to jump through. Like if you need to maintain your EIN, you need to maintain your legal existence. If you are a flow through, we're going to talk first about, is there benefit in doing this Up-C transaction? When do you expect to be profitable? When do you expect to start to need a tax shield? And then it's a time value of money thing. Do you want to do an Up-C and sell over time and potentially see if we can reap these benefits? Or would you rather convert to a C corporation now, not have the headache of trying to do an Up-C and go the tax-free reorg route? So those are some of the kind of big structuring pieces when it comes to SPACs and tax. The other item I will just also mention is just the plug to say, a lot of times tax is thought about last. And with all of the streams that a company has to go through to get to the SPAC transaction closing, the more you can get trusted advisors to be helping you with the tax considerations, to have one less thing to worry about, the better. We've gotten called in both early on and late in the game, and it's always a better process when you're thinking about these things early, even though tax is a headache to everybody. We do know that. But to the extent you can get somebody looking at this early on, it can really help save some headaches later on down the road, especially because I can't tell you how many times I've been working with Lynn and I'll say to her, I really need to talk to the company you're working with about taxes. We should have talked to them 6 weeks ago. And she's like, they're so busy on road shows for investor presentations. There's no way you can get any time with them. And we certainly understand that. And that's the piece, I guess, that I'd want to hit most is if you're a company going through a SPAC, it goes from 0 to 60 fast. The more you can get all your ducks in a row up front, I think the better you'll be in, because the last thing you want is when you're out trying to do investor presentations to have to get on a tax call with me. It's not what you want to be thinking about. So that's my plug for always bringing the tax folks in early. And I just realized I don't even think I switched to the tax slide, but there wasn't much on it. It was just some nice background for everybody to take a look at.
Amy,
so yeah, go ahead, Lynn.
We've talked a lot about some tax considerations related to the structuring. What about some of the tax considerations that come up around the closing of the transaction?
Yeah, thank you, Lynn. That is such a good point. Lynn mentioned in her timeline the point at which I think you said, Lynn, the 8K or the S4, the point at which the target is responsible for the filing, and that can catch people off guard. All of the things you have to consider on the tax side can also catch people off guard. Now you're a public company. How do you account for your transaction costs? Are there compensation-related matters you have to think about? Did you have tax attributes that you need technical review of and a study done? Did you give a distribution out to investors in a liquidity event that you need to determine, is it a dividend or a redemption? All of these things that in the past may not have been something you had to consider in great detail, now need to make their way into your income tax provision, into your public company financials. So I also find there's a lot of work that companies aren't thinking through from transaction closing to first public filing. And this is where they can also be caught off guard, and you want to have a game plan to how you're going to achieve all that. Talk to your auditors to say, and your tax advisors to come up with a good plan of what needs to be pinned down by the audit, what needs to be documented, can I do an estimate, or does it need to be 100% complete? Because that first filing, now you are handling all of the tax accounting, if you will, along with being a public company filer, and that all has to be done in a pretty truncated timeline. So that's another area. I'm glad you brought that up, Lynn, that we always like to educate people on, so they don't forget that when the transaction closes, there's still a good amount of tax work left.
And I think another factor to keep in mind is, your accounting advisors, whoever you engage, to assist with preparing management documentation or the pro formas or your MD&A, they'll be doing the analysis to determine who the accounting acquirer is for GAAP purposes, because that's going to drive, your pro formas. But that same analysis needs to be done for tax, because the GAAP conclusion may be different than the tax conclusion, because what about this should be simple.
Yes, exactly. Exactly. Thank you, Lindsay. You've learned my job better than I have in remembering all of these things. It's true that the tax acquirer is not always the same as the GAAP acquirer. There can be different answers there, and we have to make sure that we're looking at that from the tax side of things as well. And that can trip up some folks. It can also impact who has a short period return. Generally, the target of a transaction will file a short period tax return ending the day of the transaction. And the SPAC itself, it's the acquirer, they would have a full year return. In a lot of these SPAC transactions, if they might be a reverse acquisition for tax purposes, where the target themselves doesn't file a short period return. So you end up with this interesting situation where the SPAC is joining the target group, whereas in reality, you have a SPAC that acquired the target. So these are certainly some of the other considerations that we definitely need to think about and make sure that companies are thinking about when they go through these transactions.
And so we have one question that's come in. How is the PIPE investor presentation review any different from the SEC scrutiny of an IPO registration statement? So I don't know that the scrutiny is different. I do know that under your traditional IPO, it goes through a different department within the SEC for review. So a SPAC transaction is going to be filed on either your Form S-4 or a proxy statement, and it's going to go through the mergers and acquisitions group for review, whereas a traditional IPO is going to be filed on the Form S-1, and that's going to go through the IPO department desk of the SEC. So it's just different groups that have different focuses in what they're reviewing. But the financial statements of the target company should be the same as if it was doing its own traditional IPO. And what I mean by that is a PCOB registrant, an FTC registrant will need to report on, its operating segments. It's going to need to report EPS. And so you're going to have those same sort of requirements that you'll have to have included in your financial statement as part of getting your PCOB audit opinion.
Thanks, Lynn. Glad that question went to you and not me. And, I think in some summary, because thank you everybody for bearing with us for this, and we wanted to leave a couple minutes for questions and make sure that we ended timely. Those are some of the items, both tax and technical accounting and management considerations that target companies need to be thinking about when they are interested in SPAC transactions or get called up by a SPAC. There's plenty of other things out there that the companies may run into during the life cycle of this process. There can be some bumps in the road. I know there can be derailments, but as a whole, I think the big takeaway is our public company financials, the fact that we have to get management, all of the internal controls ready for public company readiness, and thinking about the fact that we are also structuring a tax transaction and going out and likely raising PIPE financing all in one. It is the mix of everything that I think accountants want companies to be doing, because you've now pretty much brought in our auditors, our tax folks, and our consultants all in one. So I always laugh about that. I feel like it's always the service providers that are winning in these SPAC transactions.
Amy, we have one more question that's come through.
Oh, great.
Should a SPAC investor expect S4 and Super 8K filed before merger completion? So no. Your merger needs to be, the merger agreement needs to be executed. Once it's executed, you're able to do your initial filing with the SEC, be it on a Form S4 or on a proxy statement. But they don't, I've seen it where it's been a week, we filed the merger agreement, and a week later the S4 was filed because we were all set with the financials. I've also seen it take 4 weeks from the signing of the merger agreement, the signing up of the PIPE, and then 4 weeks has passed before they were ready to file the initial S4. The initial S4 is filed. It takes about 30 days, and the SEC will come back with its first round of comments. And then from there, it will take, there's no limit on the number of rounds of SEC comments. We might be able to clear them satisfactorily after the first round, or we might receive 3 or 4 rounds of comments. And so it's only once the SEC clears the registration statement for the transaction to proceed, are we then looking at the SEC will provide clearance when they're satisfied that all their comments have been addressed. And then it's a 20-day holding period where the filing has to be mailed to investors. 20 days has to pass. Then we can hold a shareholder vote. The shareholders of the SPAC will vote on whether they approve the transaction or not. And at that point, you can have redemption where shareholders will take their money back. So from that, if the shareholders approve it, then the merger can close. It can close that day, or you could time it. So I had one where the shareholders approved it on September 28th, but management waited to sign the final agreement and complete the transaction until October 1st. So they had a longer window of time to finish their accounting for the transaction closing. So they played the clock in their favor to give themselves more time before they had to first report out as a public company.
Thanks, Lynn. And I just, oh, sorry, go ahead, keep going.
You can go. You're good.
In our final 2 minutes, I do see one more question. I learned how to open that up and control the slides at the same time. Are there ways in which a seller can make an asset more attractive to SPACs by packaging the asset to minimize tax complexities, liability, carve out an asset and others? And I think absolutely. I think the question really is, are you going out there looking to say, I want to do a SPAC transaction and go public via SPAC? Or have you just been called up by a SPAC investor that's looking to buy you? And this line of thinking is very much proactive. If you have unwanted assets or carve outs that you want to do ahead of time, that is certainly an option to make the company look more attractive. The other option is to potentially do carve outs at the same time as the transaction, or have a portion go do the SPAC transaction and maybe the rest go a separate way. But absolutely, anything you would think of in a normal M&A transaction where you're looking to make the target company more attractive, the same would apply here in a SPAC, of which we could talk for a lot longer about that. But yes, there's absolutely ways that you can do that. And if there's a company looking to do that, I think the best thing to do would be to either look at it on your own or talk to a tax advisor and come up with what is our strategy? What do we want to achieve? Do a deep scrub of your tax profile and see, along with your tax profile, really your company profile. Are there lines of business or assets that are just a drag on your financial statements? Anything to clean that up and get it off so you can then get ready for a potential SPAC marketing push.
And I think the last question that just came through, I hope I answered it in my first one, but is there any other indication for a public investor to be aware of merger completion before it happens if there's no public filing beforehand? So once it gets through the SEC and is cleared by the SEC that the transaction can proceed, that's the first time it'll be filed publicly. And there's a 20-day holding period. So you'll find out that there's a vote being scheduled 20 days before the transaction's closed, and you'll have the ability to request a redemption as a public investor in the SPAC at that point.
Great. Well, thank you, everybody, so much. I know that we are about to be, we are over time by 1 minute, so anybody that hung on, I appreciate it. And we really enjoyed presenting to you today, so thank you for your attendance. I don't know if anybody else has any closing statements to say, but we just really appreciate it. And feel free to reach out to Lynn or I if you have any questions.
Really, a huge thank you to Amy and Lynn. Very informative, very easy to understand. So we learned a lot. Thank you so much for sharing all of this. We will be sending around an email after the event today that will include the slideshow for your information, as well as a link to the LinkedIn group that we created, where you can continue to ask questions, and hopefully Amy and Lynn and everybody that participated can communicate via that. Otherwise, if you have a very detailed question, feel free to reach out to me. I can connect you with Amy and Lynn, or contact them directly. Thank you so much, everyone, for joining us today, and I hope to see you again at another event very soon. Enjoy the beautiful California weather if you're in California. We'll see you soon. Have a good afternoon.